Welcome to the Manitoba Ag Days podcast, featuring speakers from our 2017 event. This podcast features David Derwin from PI Financial Corp, and his talk is called Precision Farming for Your Marketing Plan.
So, precision farming for your marketing plan. It was interesting listening to the two fellows here beforehand talk about some of the key important factors when you look at the farm in general. And, you know, over the past several years, there's been a lot of changes that have taken place. And when it comes to the marketing side of it, I've always found it interesting that I've read, survey after survey, study after study, that only between maybe 5 to 10% of producers use a lot of the exchange-traded marketing tools that are available out there. But on the flip side, you also hear a lot of surveys and research done that between 70 to 80% of them want to learn more about basis levels and what are option contracts and different marketing tools that are available. So there's a big disconnect between the two of them. And why I entitled this Precision Farming for Your Marketing Plan is because I'm always amazed at seeing the technology that goes into the equipment, into the tractors. The precision that you can get now. There's even talking about how your cattle can send a text to you and say when it needs milking or when your canola needs extra spraying. So the advances we've seen on the scientific side as it relates to production are unbelievable, but they haven't quite translated yet through to the financial side, to the marketing side. And, that's self-professed by the number of talks I'll have with people, and they'll say, I can grow the best crop, we can do the best, and it's true. When you look around the world, Canadians are phenomenal at growing tremendous crops. But self-admittedly, they say, I either don't have the time or the interest or the wherewithal to look at the marketing. That's what this gap here is looking to fill. So just a quick overview of the agenda. Farm financial innovation. We've seen it with, they talk about Google is trying to make a driverless car. And, I know that we've had combines and tractors and equipment that can go driverless with GPS down the fields. Now, I know it's not going 100 miles an hour down the highway, but the technology is there on the production side, not yet on the sort of the financial side, on the marketing side. The lighter side of risk, there we go. Top 5 marketing questions, a quick overview of options and futures for those, because you'll have various levels of understanding and knowledge and exposure to that. A study I did on farming big data and how it relates to the kind of strategies that we do. Show me the money. At the end of the day, what does this mean to you? What does it mean about putting more back into your own pocket? A quick overview of the type of crop hedging programs that I'll run, some research, and then a few next steps. So let's get into it. Very quickly, some people will be more familiar with myself and the firm than others, but I've been involved in the industry now for 20 years. And I actually started off on the Winnipeg commodity trading floor. In the next slide, I'm going to show you something to do with that. But PI Financial is one of the largest independent commodity futures advisory firms. And that's important. And it's actually one of the few as well. And I think that's why only 5 to 10% of producers here in Canada really have enough knowledge and comfort and understanding in it, because there's not many people out there like me that are helping get the message out, share the knowledge and the education. So PI is a good firm to be working with because we're one of the few out there, and I focus on farm clients, helping them protect revenues, manage risks, and I have been involved in the industry for over 20 years now. And this one, I throw this one up here because you might not be able to tell back there, but this is actually my first trading card when I worked on the floor. It was probably a room a little bit smaller than this with a fewer number of people, but we used to trade canola, feed barley, feed wheat, peas at one time, flax. And you might not be able to tell, but this was done on October 31st of 1995. And you can kind of see there where canola was traded for November at a price of $396.40 a ton. What's important about that is in the past 20 years, since then, we've seen canola go up to about $750 a ton, drop all the way down to $250 a ton. So I don't know where markets are going to go, but I do know that we're going to see a lot of volatility, and that's where this kind of approach to marketing and revenue management is really important. I really like this quote because it really encapsulates how I like to look at markets and hedging for clients. The best way to predict your future is to create it, Abraham Lincoln. And to me, what that relates to is, I find that in the financial industry, when it relates to commodity brokers or advisors, people spend way too much time, and we all do it because we're human, but trying to predict where prices are going to go. No one knows that for sure. Yeah, you can have some estimates and you can have some research behind you to support views and try and get the probabilities in your favor. But I think instead of trying to guess where markets are going to do, I think it's much more important to develop strategies and know what you're going to do when prices get to different levels. So you want to manage the risk, protect revenues, and try and capture those price opportunities when they come your way. So focusing more on that, I think, is much more valuable than trying to guess where prices are going to go. The lighter side of risk, I want to take a little bit of a lighter approach to a very serious topic. And this next slide is actually probably one of the most important charts that I've seen over the past 20 years, because it kind of hits home to the psychological aspect and practically how a lot of these issues as it relates to risk and managing prices is done. So here we have a fellow in his burnt, tattered clothes, fireman in the background putting out the blaze, and fellow under the sign here saying the risk management department is now open. And he says here, as little as usual with you people, Jackson, it's too little too late. And what this means to me and what it should mean to others is that, markets are moving 24 hours a day. It doesn't mean you have to follow them day by day, tick by tick. There's not much value in that. But what you do need to do is have some kind of process in place to learn about marketing outlets. This time of year, we're at events like this. There's a lot of them across the prairies where they do focus on marketing and learning about hedging. So, your risk management department isn't something that open and closes. It's really something that you need to, have as part of your weekly, monthly, quarterly kind of decision process, like all of your other decisions. So for me, the risk management department doesn't close. Next slide here I think is important because, one, it's funny, but two, it hits home a very important point. I saw this slide at someone else's presentation. I thought it was absolutely brilliant. And it says here, psychic fair canceled due to unforeseen circumstances. And I think when it comes to marketing and trading and where prices of wheat are going to go, everyone thinks, well, you got to know where the prices are going to go. You've got fancy formulas and charts and analysis. And at the end of the day, you don't know where it's going to go. And I think if you, again, you realize that and go back to the idea of, let's find strategies to deal with the unknown instead of trying to guess them. Top 5 marketing questions. These come from 2 studies that were done by both the Saskatchewan and the Manitoba governments, basically a self-assessment on various areas of farm businesses, from production to labor to health, and of course marketing. And I picked out these 5 because I think they're really important to think about. Number 1, set marketing goals that can be measured and have a written plan. And some people might price a third of their grain in the winter, another third coming into summer, and then perhaps another third coming into harvest time. Having something in place is important. Even if you write it down on sticky notes, it's a starting point. And some people I work with, I see, have fairly developed marketing plans, and others, that's the whole process of putting something in place that's written down. Now, this isn't something that you just write it down, stick it in a drawer, and forget about it. It's something that you want to look at on a regular basis. Keep an eye on it, revise it. How have things changed? If you start pricing a little bit more, do you, need to make adjustments throughout the year? So it's really a working document, like so many other plans that you have in place. From what's your field rotation plan, that kind of thing. So you want to have it accessible and use it on a regular basis, and that's something that I will advise people and heavily emphasize that they develop. Having the interest and the skills to make good marketing decisions. Not everyone wants to. Not everyone can. They say, what, I don't deal with that. My wife does all that, or my son does all that, or my partner does all that. That's fine. You don't need to be an expert in that area, but you need to have someone within your farming business that does focus on the marketing. And it can either be internally or working with an advisor that can help you make those decisions. Using options and futures. Again, one of the tools that is really heavily underused here in Canada. I mentioned earlier that about 5 to 10% of Canadians only use them in their farm operations compared to about 35% in the States. A couple of reasons for that, probably because the history, whether love them or hate them, of the wheat board affected the decisions on how to look at marketing and what needs to be done. The commodity exchanges in Chicago have a very heavy presence, and a lot of education is provided. So learning about these tools, I think, is really important because they are, options and futures are kind of like a Swiss Army knife. There's a lot of different applications for them, so they're a really good tool to have in your marketing toolbox. And then it's just part of, the options and futures or the marketing tools that are out there are just part of your overall strategy. They combine with your cash process. What can you store? What's your delivery requirements, operations? They all really have to come together. So these are the two studies that it comes from, Gaining Ground in Manitoba and Taking Stock. If anyone's interested, I'm more than happy to send you links, but they're really good studies to sit back, take your wine, your tea, your coffee, your beer, whatever, and think through them, and it's a really good exercise. So that's a good way to start the process of developing a marketing plan. Futures and Options 101, usually at this point in time in a smaller room, I'll ask how many people either have awareness or use them or have taken courses, but I'll just go over them very, very quickly. For our sake, there are futures that trade on open exchanges on the majority of the markets that we all deal with, from wheat, canola, cattle, Canadian dollar. There's ones that you can hedge fuel, corn, soybeans, hogs. There aren't any that have been developed on the pulse crops, and I wouldn't hold my breath on that. So those ones tend to be a little bit harder to hedge. But the fact that you do have a lot of availability on other crops gives you another outlet when you're marketing your grain. And times have changed. This is a picture of the Chicago Board of Trade, and when I went to Chicago, that was always my favorite place. Forget about the art galleries or the waterfront. I always loved going to the exchange, and that's the building where the markets trade in. Now, you can do it on your phone. So it's extremely accessible. There's no excuse not to be getting yourselves up to speed on this kind of thing because it is out there and available. Different terms that come together, you might hear pricing or hedging or risk management or protection or insurance, and they're all kind of interchangeable. Don't get too caught up in the specifics of it. Just know that the whole idea is finding a way to manage your revenue, whatever you want to call it. Futures contracts, very much like your production contracts. You don't have to commit and deliver your grain into a futures contract like a production contract, but essentially it's a mechanism that allows you to lock in a price. So you're able to at least you don't get any upside, but you don't have any more downside, so it's kind of like a production contract in that way. Option contracts are a little bit more like insurance in the sense that you invest in premium, you got your downside risk covered, but you still have all the upside, just as you would buy insurance on your buildings, on your equipment. That's how you want to think about options. Is you get basically the downside protection that you need, but with the upside protection that you want, because you still have that option of benefiting from higher prices. Quickly here, this is a study that I did that looked at a lot of the misconceptions and the reasons why I think a lot of people don't use some of these tools enough. And it addresses a lot of the myths that are out there, like, do markets trend all the time, whether seasonal patterns or random, are markets really random? So it's a study that I did that really supports a lot of the strategies that are put together for producers to better manage risk. So I mentioned that because it kind of forms a bit of the foundation of the type of hedging that I'll look at, where we're trying to provide you, again, with that downside risk, but without the upside. The downside protection, but with the upside. And the objective is exactly that, is finding a better way to protect your revenues, hedge your commodity risk, and really just trying to advance and promote and develop better marketing strategies to Canadian producers. Show me the money. Everybody wants to find out, okay, this sounds all really good, and I get it, I don't get it, I want to learn more about it, but what does it mean to you at the end of the day? So when you start looking at some actual numbers, and this is where it ties into what the two fellows were talking about earlier from the Providence about cost of productions and using spreadsheets. So what I did is this is actually from it's from the Manitoba Ag site, and they've got a lot of really good online resources. But I look at this because it's basically just a crop production schedule, and it allows you to change different variables. Prices go up and down, if your yields go up and down. So it's got what operating costs are, different price levels that you sell it at, what your profit gains and losses are. So what does all this mean to you? I mean, we spent a lot of time about extra fertilizer applications. They're trying to cut costs here and there, and that's important. But don't forget, revenue is 100-cent dollars, okay? And so if you can make a small improvement, 5-10% on 100-cent dollars, it makes a big impact on your bottom line. It doesn't mean you don't do all the other operational things to continue to reduce costs and be more efficient, but it reminds me of the one fellow, Christian Hebert, who many of you may have heard, and he's an excellent speaker, but he just talks about that 5% solution. Making little 5% changes here and there really add up. And nowhere, I think, is that more true than on the marketing side, because, again, you're dealing with 100-cent dollars that can go right to your bottom line. So if you look at an example here, let's just say that prices increased by about 5% from what what they used as the baseline or the benchmark there. Well, that can add an extra 13% on your gross, and it can can more than double your your net profit. Okay, numbers go up accordingly. If prices go up by 10% here, then that can have a 25% increase on your gross and more than triple what your net's going to be. Same thing. If it goes up 20%, if you can capture some of those big rallies, then that just puts more money in your pocket. Same thing also works on the downside. If prices drop, say 5% from where you may have budgeted or your estimates are, well, conversely, that drops your gross by 10-15%. If prices drop down 10%, even bigger impact on your bottom line. And of course, if we get some really bad years, then that can have a really dramatic impact on your bottom line. And a lot of the hedging here is not just about trying to capture the really, really good pricing. It's also, they're kind of like insurance, so that a mediocre year or break-even year doesn't turn into a disaster year. So the numbers are quite compelling when you start looking at what it can mean when you crunch through, when you know your cost of productions, when you've got all these numbers in place. And this is just one outlet. There's a lot of software that's out there, but it is good to have something like this so you can get a little bit more precision in your overall process. I want to go through that very quickly now. I call options the farmer's best friend because over the years I've always wondered, well, why is it that only 5-10% of people really only use these tools that are out there? And various reasons, but there are three that really start to hit home for me. And that's why I've termed this the commodity revenue option protection, because you're using options to protect your commodity revenue. It's just an acronym, but it tends to reflect what it's really trying to do. And the number one reason why a lot of people don't look at hedging more, and rightfully so, is in the springtime or when you're seeding. You don't know what's going to come out of the ground at harvest, so there's a lot of delivery risk, and there's a lot of commitments that you have to make. The nice thing with options is you're not dealing. If you're using exchange-traded options, it's separate from your production, it's separate from your delivery. All you're doing is protecting your price. So you're not going to deliver any of your grain to me. I don't want your grain. You still deal with your elevators and your buyers as you would already. But what it does do, options give you that ability to still have some protection in place, but not have to worry about crop failure or committing a whole bunch of your production, and then all of a sudden you get a crop failure, and then there's all of a sudden big penalties with the elevator. So that's usually the number one reason why I see people don't use some of these tools. Number two is you don't know where prices are going to go, right? And how many times does it happen where you set a target price, 2 or 3 weeks later it gets hit, you go, great, my target price got hit. Another 2 or 3 weeks later, prices are up 30, 40 cents, and you go, darn, my target price got hit. So we're never going to capture the tops all the time, but what it does is it gives you a little more flexibility. Again, it gives you the downside that you need, but the upside that you still want. So, we're all human. We don't want to, lock in a price and then see it go higher. Options gives you that other ability to still have your protection in place, sleep better at night, but if there's a big rally, you can still brag about it to the neighbors at the coffee shop. And then the final one is with futures contracts. Very often, we've heard about someone's friend's uncle's brother down the road who used options and it didn't work, and then they said, futures and hedging doesn't work. Well, the nice thing about options is there's very, very minimal outlay. You don't have to worry about those concerns about margin calls, which I know in the past have scared people off. So those are the main reasons why I found over the years producers don't use some of these tools, and accordingly why we're trying to find ways to bring it around to show how they can still be used, but avoiding a lot of these three main concerns or issues. And this is what it looks like at the end of the day. I mean, if you do nothing, this red line here just shows what, no hedge. You got, your grain is sitting in the bin or it's out in the field. You got all the upside if prices move higher. And this is just an example of grain price per bushel. And if prices go up, of course, you're getting all that upside. If prices go down, you're seeing the revenue dwindle accordingly. And then you've got production contracts, which lock you in at a certain level. You got no downside risk, which is kind of nice. But you're giving up a lot of that upside potential. Even if prices go up, you're not really going to be increasing what the farm might make. So you're kind of giving away a lot of that hard work and effort and smart work that you put into it, where options provide a little bit of that nice middle ground. Have your protection, you still have your upside, and it balances an overall program. So what I want to go through here quickly is an actual process that we went through in 2014. And 2014 is a good one to look at because of just transpired in the markets, and it really exemplifies how options can be quite easily put into an overall marketing plan. So this is what canola looked like at the end of 2013, and this is November 14. This would have been new crop canola at that point in time. And it was kind of basically just hovering around and around and around the 500 mark. It started dropping lower. Prices moved up, but it was hovering right around 500. So very early in the year, again, a year out, you don't want to get too aggressive with locking in prices, but you want to at least have some kind of downside in place in case it started dropping down into the low 400s. And that's what we did. We bought insurance on canola for new crop November 2014. And don't get too worried about some of the numbers here. But what it means here is 490 was just that level of protection. So you had canola priced a downside protection of 490. You still had the upside potential because you're not locking in. Again, you're just looking at that downside price insurance. And it cost about $30 a ton. Okay? So not cheap, not expensive, but you're hedging out about a year. So that gives you a pretty long window with which, even if prices moved higher, you'd still capture that upside. But if prices dropped lower and lower and lower, again, you at least had a little bit of the new crop protected. So we fast forward the charts a little bit, and in fact, prices did drop a fair bit, and then we recovered a little bit, coming back to that 500 level, which seemed to be a fairly important level because 500 was very key here. It seemed to be, for whatever reason, there were a lot of buyers here, and it got back up to that level again. So we've considered, 500 might not go much higher than that. Let's look at a little bit more protection, okay? A little bit down lower. Again, this is downside protection at 465 and cost about 22 a ton. So same thing, just like insurance. That's your level of protection, and that's the premium that you paid. Markets continued to go higher, just couldn't get above that 500 mark. But even if it did, again, with options, you've got that upside that if it did go higher, you could still benefit and participate in that. But prices just didn't seem to want to move up. Why? You're never going to know. And if you try and figure out that and follow every little bit of news or what's happening in Brazil or what China's doing or what Japan did, you'll drive yourself crazy and you'll still never find out the answer at the end. But what we do know is that the prices just weren't moving higher. So added a little bit more protection. Another 480 level at $26 a ton. And all these decisions are made usually in increments. At any given time, we might hedge maybe 5, 10, 15, 20% of the crop. If we want to be a little bit more aggressive, maybe 30%, okay? Knowing all the time that you're not committing production, there's no delivery risk, it gives you that ability to maybe go beyond a typical pricing level of maybe I'll do 50% by summertime. Well, if prices really have a big rally, you want to capture that, but you're going to be a little bit hesitant to lock in more production contracts. So, I think in this case here we probably added about another, because 500 was a fairly important mark, maybe another 25% of potential production. So it just gave us a fair bit early in the year, and we're only in May here too, right? So we're still only in late spring, early summer. So we had a decent amount in place. Clients will also have priced a little bit with the elevators for delivery and storage reasons, but at least we had some options to balance that overall process. And it's a good thing we did, because then we all remember what happened. It went pretty much straight down into fall-time harvest, and prices did drop down to about 400. So having a lot of protection in place really made a big difference in this crop year. And every year is going to be different. But as just a quick summary of it, again, this is where the futures prices ended up. You recall here, this is where we ended up in fall time when you would have delivered your grain. So the first position, that was the level of protection we bought. That's where the current market ended up at the end of the fall time. That's the premium we paid on all these different positions. Again, remember 1, 2, 3. And that was the net. The price, and this doesn't include your basis. I mean, your basis level is still something that you still determine with the cash elevator. But at least it gives you a sense of the extra gain. So an extra $55 or $54, $37, and $48 a ton gain on what your selling price would be. So an average about $46 a ton. You tack that on to what your selling price is going to be, and that added a nice amount of revenue back onto the sales side. And that was the case for a lot of the programs, because wheat, same thing, very tough year for wheat in 14, and it dropped, but the programs here added an extra 82 cents a bushel. Soybeans, same thing, about $1 a bushel. But overall, a very good year in 2014, because it added anywhere from 10 to 15%. Every year is going to be different. 2015, and I audit this and I keep track of all these numbers, and not really all that much. I mean, soybeans, that might have added maybe 10, 15 cents. Not a big deal. Added a lot on wheat, because again, wheat had a really down year as well. 2016, there have been some good pricing opportunities, and it's going to change, right? Every year is going to be different. But the one thing to always keep in mind too is that you always have your upside. So if you buy options at 500 for canola, where it's sitting at now, and you might invest, different strategies, but $15 premium, 20, 10, whatever it might be, and if canola goes to $600, you're still going to put that $600 in your pocket. Yeah, there's a little bit of money invested in the premium, but that's a small price to pay to sleep at night and potentially get the upside. So that's always something to keep in mind, is it gives you that flexibility in your overall marketing plan. And then I look at, and these things can hold true for something like cattle as well. We went over that, and as we know, cattle prices, and I remember 2013, 12, 13, 14, went up and up and up and up. And in the last couple of years, they've been pretty much drifting lower and lower and lower and lower. And who's to say they can't go lower? Nobody knows exactly, but these are the kind of tools that you want to add into that toolbox to give yourself that flexibility. So that's kind of an overview of how some of option hedging can work. Sometimes the decision when you're looking at marketing, just like you are with the elevator, is do I want to price any today? Same thing is, do I want to look at any option strategies? And actually been pretty quiet lately, because canola and soybeans drifting their way higher. Wheat, well, I mean, wheat's a tough one. I mean, maybe the best way to protect you against your wheat prices this year is not to grow as much. But wheat could be the surprise, right? I mean, when everyone is so bearish and concerned, everyone says black, maybe it's going to be white. Or if not white, at least it's going to be gray. So this year, we are looking for some opportunities to price a little bit at higher levels, but you just don't know. And that's what the value is, because instead of canola going up, it could very well drop down to 400, because we don't know. Remember, it was at $250 a ton before. It could get there again. We don't know. Some of the research that I apply here also affects other markets, because one question that I get a lot is, well, how do we deal with, let's say, fertilizer prices? Is there any way that you can hedge and protect fertilizer prices? There used to be contracts that traded on the Chicago Exchange on fertilizer, but those have many years ago, those have long since become extinct. They just didn't trade. They were too illiquid, and they weren't used anymore. But I'd still get the question. I always want to find, well, how can I try and help people when it comes to that? I can't necessarily do anything. If you've got storage capacity and prices are low, or the local dealer's providing a good deal, maybe you buy it and store it. But one thing that I did look at is, what else affects fertilizer prices? What kind of market-based information is out there to give us maybe a little bit of an insight into what fertilizer prices might be doing? So what I looked at is two companies, two of the bigger ones that produce fertilizer. Makes sense? You know, if they produce it, they're probably going to do fairly well if fertilizer prices are higher, not so well when fertilizer prices are lower. So after analyzing about 20 to 30 years of data, comparing fertilizer stocks, in this case Potash Corp and Mosaic, with fertilizer prices, there was a correlation between the two. No surprise. I mean, if you produce the product, it goes up or down, your stock price is probably going to go up or down as well, because that's what this is. This is just the stock price of Potash Corp and Mosaic. But what I found more interesting is the correlation was pretty high, pretty close to about 90%. And anytime I see a connection between two things that are about 70% of the time, that's worthwhile looking at. When we get into 90s, it really makes worth a while to pay close attention. But the real kicker was that these fertilizer stocks tended to lead fertilizer commodity prices by anywhere from about 3 to 6 months. That's kind of like looking through a window and seeing the future for about 3 to 6 months out. Not going to work every year, not going to work perfectly all the time, but at least it gives you a sense of where fertilizer prices might go. And now, these two stocks have pretty much been going sideways for the past year, and if I updated this chart to today, we're probably closer to here. So might fertilizer prices go up? I don't know for sure, but that comes back to your decisions. Can you get good, good prices at the local dealer? Do you have room to store it? All factors in the equation. The other one that I'm going to go over very quickly too is, I do a lot of work on the investment side for clients as well, so I'm always looking at stocks. And there is a fund out there called MOO, appropriately enough, MOO, which basically is just a basket. It's a fund of a whole bunch of agriculture and agribusiness related companies. So Potash Corp, Deere, ADM, Bunge, a lot of them are on the list here. And this kind of shows the same type of thing where we had a couple of years of some pretty weak prices in all these stocks. We're starting to move again higher now. If all these companies derive their profits from essentially you guys, because you buy all their products, it kind of gives a bit of a lead indication of what the general health of agriculture might be. Okay, so I look at this as just a bit of a guide, and we still could be in for some weaker pricing, some tougher times, but we've come down a long way. Still, all the more reason to look at the kind of hedging tools that are out there. But this kind of research and analysis and data crunching, it adds to the whole conversation of what's going on down on the farm. Not just on the selling side, but on the cost side as well. And fuel prices was one that when oil, prices went from $100 down to 30, and going out to Calgary on a fairly regular basis, I remember that when they went from 100 down to 80, and said, well, they can't go down much below 80 to 70 because that's our cost of production here on the tar sands. They went down to 50, down to 60, or 60 down to 50. Well, it can't go lower than here because we're not going to be profitable at these numbers. Well, it went down to I think the lower price was 29. So prices can go lower than we might think. They're also going to go higher than we might think, and we just don't know that. But I think the value is having something in place so that when these prices do move, or better yet, before they move, have something in place so that you've got that protection level there. So what are some of the next steps that you can look at? I think that's important because I want people to take something away with them. If so few people don't have enough knowledge and understanding of it, but people want to learn more, we really got to find outlets where you can do so. One of them is a site that I really like using, pdqinfo.ca. And it was put together by the Alberta Wheat Commission, and actually the fellow who might be in the crowd here who did a lot of work on developing this. But basically what it does is it has various commodities from wheat to canola. There's also peas in there across different regions in the prairie. So east, west, man, across Saskatchewan, across Alberta. And all it shows is basically cash price levels. You know, if you've got a lot of elevators in your area, then you probably have a pretty good sense of where prices are going or where the bids are. But what I find is this just gives a little bit more open transparency on the market side so that you got another sounding board, if you will, for where prices are. And I find it very helpful because when I talk to people across the prairies and I ask them what they're seeing for, you know, the cash price for their CPS, let's say, and then I go and take a look at what prices are here, they're not too far away. So it's a good tool to get a better sense of maybe where market prices are in general. If you want to look more at futures and options, cmegroup.com is it's the best place to go for data, charts. There's some educational tools that are available. I have a lot of them that I can make available as well. But CME Group is just Chicago Mercantile Exchange, and they are the dominant exchange in the world, really, that trade pretty much all of your markets or all of your commodities. So CMEgroup.com, great place to go to learn a little bit more, get a little more comfortable with pricing and charts and options, that kind of thing. Another one is commoditycharts.com. Very accessible on your phones, can track pricing that way. I'm sure a lot of you do this already, but it's just another outlet that you can look at. And if you don't do it on a regular basis, it's not a bad idea to. I mean, everyone gets busy, but I mean, it doesn't take much for a week to go by or a month to go by and you say, wow, where did that last $40 in canola go? You know, so keeping on top of prices is always very important. And getting more information, I'm finding that there is more of a need. We're seeing it more and more in universities. A lot of events like this are tending to focus more on the marketing side, the financial side. And one thing that I do, I'm also an instructor with Lethbridge College as part of their Ag Business Risk Management program. So they're really good courses. Every month they got a different module. You can pick and choose how you want to do it. What I find is there are a lot of people who I tend to see both ends, where there's people that are getting new into farming that want to learn more, maybe expound on what they may have taken in university. And then I got the people in their 60s who have been doing it for years and say, you know what, I think I better learn how to do this, because if I want to pass along some, you know, maybe better marketing processes to my business partner, my kids, my whatever, when I'm gone, I want to find out about. So that's another good outlet. So those are the things as a bit of a summary. Those 5 marketing questions I think are very important. You know, again, I'm more than happy to send them to you, but just think about those. You know, do you do your marketing? What does your marketing look like? We're coming into a new crop year. What do you typically do? What do you want to do different? You know, winter is a good time to do that and actually put in place some kind of process. Learn a little bit more. Those websites I gave you, CME Group has got plenty of information. I've got a lot of analysis that's available, a lot of information. I'm more than willing to field any questions. I know it's lunch break, so this room is not used afterwards. So if anyone has any questions, either down here or up there, I'm more than happy to spend a bit of time. And you know, feel free to connect with me as well. I mean, on a regular basis, I find especially new people that are trying to learn about some of these processes, you got to get comfortable and confident with it first. So I'm a big believer in providing that level of education so that you can use it, so that in 6 months, after you get used to this stuff, people say, well, this really isn't all that hard. And I say, no, it's not. But the difference is you took the time to learn about it. So those are some of the steps that you can take away when you go from here. And I think we're probably more or less on time here. If there are any questions, I'm more than happy to take them. If you want, I'll be here afterwards as well, either up here, down here, maybe up in that open area. So I'm more than happy to elaborate on things that we went through here. I know it was pretty quick, but I just wanted to get more so than the details of how it's done, is knowing that it can be done. And I think that's probably the more important thing, is to know that it's out there, figure out ways that you can incorporate this into your business operation and use a lot of these tools because they're there and you might as well use them. So thank you very much for your time, and I'm more than available for questions, and I guess I will pass it back to you then, Darren, and go from there. Thank you.
Thanks for listening. We'll see you at Manitoba Ag Days 2018 from January 16th to 18th.